Think of modern advantage as layers of asymmetry and begin with speed and execution. At the top end of markets, firms invest in co-location, bespoke network stacks, microwave and laser links, and hardware tuned to shave microseconds off message round-trip times. That raw latency edge, historically the domain of HFT firms, remains a gatekeeper. Lower latency lets one observe order flow and act before others can, capturing tiny profits at massive scale and letting sophisticated models compound those gains. Today, those execution stacks are integrated with machine-learned models that predict short-term order flow and optimize order placement to reduce market impact. Combining hardware, custom software, and ML yields execution outcomes that are materially better than what any retail trader or typical asset manager can achieve. This is not hypothetical. Long investigations and industry analyses document how speed, execution algorithms, and automated market-making strategies continue to produce asymmetric returns for firms that can afford the infrastructure. Layer 2 is data, scale, and pre-processing. Ultra-large funds and family offices buy, license, or build access to datasets that most players simply cannot obtain or process at scale. Point-of-sale feeds, proprietary scanner, retailer telemetry, satellite imagery, shipping manifests, credit card-level aggregates, and bespoke sensor networks. Those raw feeds are useless unless cleaned, joined, and modeled. That's where AI multiplies value. Machine learning models, from classical gradient-boosting machines to deep nets and modern LLMs used for feature engineering and unstructured data parsing, extract signals from noise and create structured predictors that human analysts would miss. Because these firms run thousands of experiments, they can statistically validate tiny edges and then scale them. The combination of unique inputs plus advanced AI for feature extraction leads to information asymmetry that is empirically observed across the hedge fund industry. In short, exclusive data plus AI pre-processing shotgun insights others can't see or act on. Layer 3 is modeling sophistication and tooling. The richest firms operate in-house AI research labs, maintain teams of PhDs in statistics, signal processing, and systems engineering, and invest in training pipelines, backtests, simulation environments, and dedicated GPU/TPU fleets. These resources let them A. build models that incorporate many heterogeneous signals reliably, B. run realistic counterfactuals and stress tests, and C. deploy models into fast production safely. Recent reporting shows quant titans and large hedge funds are increasingly adopting large-scale machine learning, including transformers and generative models, to generate features, synthesize research, and even prototype strategies. Some firms publicly state this transition, while others quietly accelerate it. That institutional stack, talent plus compute plus engineering culture, creates a sustained edge because model performance often depends more on engineering and data ops at scale than on clever but isolated ideas. Finally, consider privilege, optionality, and regulatory organizational advantages. Wealthy players can pay for privileged information flows, legal market intelligence, bespoke consultancy, and early corporate access. Hire lobbyists or compliance teams that interpret and shape rules and create organizational processes that systematically preserve optionality. Many small protected experiments, plus a few concentrated bets. They also internalize downside with instruments and legal wrappers unavailable or uneconomical for most investors. On top of that, they can recruit elite AI talent away from academia and big tech by offering equity, unique problems, and huge budgets. Talent then builds models and systems that are hard to replicate. Some startups and data vendors are attempting to democratize access to datasets and tooling. But the pace of arms race investment in AI hardware and exclusive feeds means the asymmetry persists. The ultra-wealthy are structurally advantaged not only by money, but by the complete stack: connectivity, data models, people, and governance that multiplies AI's effectiveness. The second layer of truth lies in speed and execution. At the very top of the financial infrastructure, microseconds matter. Ultra-wealthy investors and institutions operate high-frequency trading systems that combine co-location servers, laser and microwave transmission, and custom-built hardware optimized to cut every fraction of a millisecond. What makes this edge even sharper today is the integration of machine learning models directly into execution stacks. These models analyze real-time order flows, predict short-term market microstructure shifts, and optimize routing, so trades consistently capture better prices than the average participant. By multiplying microscopic price improvements millions of times a day, this transforms into billions in aggregate profits. Regulators, academics, and industry reports confirm that this isn't conspiracy theory. It is a documented and persistent driver of asymmetry, where speed married with predictive AI gives the ultra-rich a battlefield advantage most investors can never access. The third layer is exclusive data and AI-driven signal extraction. Wealth at scale buys access to information streams invisible to retail traders, credit card transaction aggregates, shipping manifests, global supply chain telemetry, and even satellite imagery of factory parking lots. Alone, these raw data sets are overwhelming, but processed through advanced AI pipelines, they become predictive gold. Computer vision models quantify consumer traffic before earnings reports, natural language models extract supplier stress from logistics filings, and time series algorithms detect anomalies in demand. Funds with these resources can often anticipate corporate performance before it hits public disclosures. Public cases have already documented hedge funds using satellite images to forecast retail sales, and the trend is only accelerating as geospatial and alternative data marketplaces expand. This creates an informational moat, a structural divide, where the wealthy trade on insights carved from data that most of the world never even knows exists. A third advantage sits in the NLP revolution applied to unstructured text. The world produces millions of words per second in earnings calls, SEC filings, regulatory updates, CEO interviews, and even subtle shifts in tone across conference transcripts. Elite institutions deploy natural language processing at scale to convert these oceans of words into quantitative trading signals. Algorithms detect not just sentiment, but nuanced changes in language, a CFO subtly hedging, or a CEO choosing words that historically precede underperformance. These signals are then injected into quant models, giving funds the ability to react hours, even days, ahead of slower analysts or retail investors. Independent studies and industry research confirm that language-based features have become a measurable source of alpha, exploited aggressively by those who can afford the infrastructure. Once again, AI becomes the amplifier. It compresses oceans of information into actionable patterns before the rest of the market has time to breathe. Finally, we cannot ignore AI-enhanced execution, risk management, and organizational advantage. Reinforcement learning agents now optimize block trade execution across fragmented liquidity pools, minimizing slippage that would cripple ordinary investors. Risk engines powered by AI run tens of thousands of counterfactual simulations, ensuring portfolios not only capture upside, but also preserve optionality during crises. Beyond the models themselves, the wealthy possess governance advantages. They can fund in-house AI labs, contract exclusive data providers, hire elite PhDs, and secure compute power at a scale retail cannot dream of. The result is a compounding cycle. Capital buys data and talent. AI sharpens strategies. Superior execution and risk handling generate outsized returns. Those returns are reinvested to widen the moat. It is not a single unfair edge. It is a stacked architecture of advantages, each layer multiplying the other. This is the uncomfortable truth. Artificial intelligence is not leveling the playing field. For the ultra-rich, it is widening the gap, institutionalizing a form of informational inequality that ensures they remain steps ahead while the rest of the market plays catch-up.